Thank you for coming. This is a great space, my first time here, although I do know Aiko. Aiko was in my class at Stanford, so it's nice to see her. And Matt, we've worked with before at SoFi, so good to see you again. But to everyone else, hello. What I wanted to try and talk about today, try and keep it interesting, interactive, and leave as much time for questions as we can. But to give it some theme, and just so I didn't pitch up here and take questions, I thought I wanted to speak about how I believe that customer service really counts. And I think, I'm not sure all the businesses that you guys are building, but I'm guessing many of them are tech businesses or tech-enabled business. And I do believe that there is a perception out there that if you're starting a tech business, it has to be ultra efficient and almost you can do everything on the device, and real human interaction, customer service maybe doesn't have a place. And I think that is true for some businesses. You know, Uber, I want to press the button and I want the, hang on. And I want the car to be there outside, and ideally I don't want to speak to anybody because I think that's a regular, everyday kind of transaction. But I would argue that for many businesses, and SoFi is in that category, where there's a high price tag or a large investment going in on one side, I think people expect a little bit more, and people want a little bit more of a human touch. So this is not an earth-shattering slide. You know this, but technology is changing many industries. SoFi is in the finance world, and when we started back in Stanford in 2011, we didn't really believe that finance had changed very much. I think it's starting to change now. SoFi and other companies are starting to do that, but it's slow. And I'm not dissing technology. Like, technology is fundamental to the whole experience for almost any company now. I don't really know what a technology company is anymore, because every company has to have technology, and it has to be mobile enabled. The number of people signing up to our site now, signing applications through mobile, it just goes up, even in the short 4 years that we've been around. We've tried to make it as simple and intuitive as you can, because people have really low attention spans now, and if it's not simple, if they get stuck, they'll just leave you and go to the next guy. And you have to have, as much as possible, an instant response. So the days of banks being able to take applications in and then, you know, wait a week and then come back to you are long gone, and good riddance to them. But I would argue that technology isn't the only requirement. I believe that for many industries, ours included, personalized customer service through real people is required, particularly for us when you're dealing with such big ticket purchases. People want that reassurance that they're dealing with a real company. Maybe before I go through this slide, can I just ask, how many of you guys had heard of SoFi before the invitation for this event came? Okay, that's good. So our marketing's generally working pretty well. That's good. So we've been around now about 4.5 years. We do student loan refinancing, mortgages, and personal loans. We've just expanded to the investment world as well. So we can take your money through an asset allocation product. In terms of numbers, we have this many members, over 120,000 now. We've funded over $7 billion of loans. We have raised a lot of equity, and I can speak about that if there's interest. And the employee number is continuing to go up quickly across 5 or 6 places in the US. We just opened a New York office a couple of months ago. So that's a very brief background. And I think we've been able to grow the company over the last 4 or 5 years with great technology, but then mixed with real people. And I want to concentrate the next 15 minutes or so on those real people and the quality of the customer experience that I believe that we are delivering. So a really important one for us is live customer support. So we've found that a lot of people just like to speak to people. Even if you have the simplest application form in the world and you can go through it, there is a psychology among some people that think that's almost too easy. Like, I went through that application in 3 minutes and I applied, and now you're going to give me $70,000. What's the catch? So many people often just want to call and check that what they did was correct. And again, because it's a big ticket, the economics work out. We can do that. You have to be open evenings and weekends. I mean, yeah.
Is there data that you're willing to share on what percentage of applications actually lead to a phone call pre-submission or
so
submission? I just wonder what the amount is. It's like
1 in 3 or 1 in 4 end up funding. which
that's much higher than that.
yeah, it's compared to the industry, it's.
Does that break down? Is there an age group that?
I mean, we don't actually ask for age. We're not allowed to ask for age when you're lending. You can make inferences from when people graduated, but I don't know the breakdown by age.
But there's nothing else that stands out about that third that really calls it out.
Generally, the people that are saving the most money will be the ones that convert. So if we're taking your interest rate in the case of student loans down from 8% to 3%, you have a much higher chance of conversion. We have a much higher chance than if we're only taking it from, if you're already at, say, 5 and we're bringing you to 4. For some people, then they drop out.
Sorry for drawing you.
No, it's okay. Keep them coming. And then this put a dedicated customer support. At the beginning, we got feedback from people that they had to speak to, maybe they called 5 times during the process, which is relatively unusual, but maybe they did because they wanted to. And maybe they spoke to 5 different people along the way. And maybe they had to say thing to every 5 of them. So we listened to that and we changed it. So now you get allocated a dedicated person. So wherever possible, if that person is in the office, as soon as you call up, you'll be routed to that person. So as much as possible, you're speaking to one individual who can get to know you over that week period where you have your questions. And we've had great feedback on that. And the last point, it's kind of an obvious point, but it's just having really highly motivated employees. So our call center, we don't call it that, service center is in Hillsburg in the wine country in California, which isn't the obvious place to put a traditional service center. You'd probably put it in some tax advantage state somewhere where you can frankly pay people a little bit less. But we wanted to make sure we got people that were really highly motivated. We pay more than we need to pay, and our retention is extremely high. Very few people leave us. And generally, people are extremely happy to be there, and that conveys to the callers. So when someone's calling up, asking a question, they're speaking to a happy person on the other end of the line. And we believe that that's highly important. It's something that really has been lacking in the financial industry in general. There's no press 1 for this and 2 for that. You just go straight through to a real person. This is a quote that I saw just on a review site recently, and finance is not that complicated, but I think a lot of people put a lot of barriers up around it. It's not necessarily the simplest of transactions, so we try to make things as easy as we can, and that's bearing fruit. Okay, now I just want to see if the technology works and play this video.
My name is Victor Perez. I went to IESC to do my MBA in Barcelona. It was an amazing business school. In Europe, it's considered to be the #1 or #2 school. Obviously, when you graduate from a graduate program, you have a lot of diplomas. I basically felt claustrophobic almost. SoFi felt different. First, I thought it was too good to be true. I had 2 loans, and I just refinanced both of those into one unique package with SoFi. So I met the most amazing woman in the whole world. We decided to get married just after the MBA and had an amazing job. Everything seemed set. 2 weeks before we were going to get married, I was actually laid off. I didn't know what to do. I really wanted to go forward with the wedding. She did as well. SoFi did make it a lot easier. They gave me the option of forbearance, which was basically stopping payments on my loan. They really helped me to see the light at the end of the tunnel. Right before Christmas, I got the good news, and I got the job open. I'm going to be doing marketing for an oil and gas company in North America. My greatest inspiration is my wife. I just love being there for her, that she's there for me as well, and that we love each other and just want the best for each other. She's here in the room. I have to say that. She's here. That's actually the truth.
I almost cut off the ending there. So that's Victor. Victor was a customer who we got to know through our career services team. And I think it's an example. I want to show you the video because I think it's more powerful than me telling you about what we do for our members. He was in a tough situation, as he said. He was engaged. and 2 weeks away from his wedding and he loses his job. So it's a pretty bad situation to be in. But we want to work with our members and we want to help them, and we don't want to be coming around just trying to collect the debts because you still owe us the money. We want to help you as much as we can. So we have a feature called unemployment protection where we put your loans into forbearance, so you don't have to pay anything back for a period of time. But then I think more importantly, and the thing I'm more proud of, is that we'll connect you with our careers services team. So we have a team at SoFi who are 7 people strong now, and all they do each and every day is help our members to find a better job, or in a situation like Victor, find a job where they've lost it. And we think that's very powerful, and we've helped now over 160 people to find jobs who were unemployed. It's obviously good for us because it means that people can pay us back. So we're not going to pretend that we're just the nicest guys in the world, though we are. But we also think that it's good, obviously, for those people because it gives them a helping hand.
Is that monetized like a recruit or a recruit structure too?
No, we don't monetize it, so there's no charges for anybody. Equally, the companies are not paying us. At some point, if it gets big enough, maybe we'll think about that. At the moment, it's just a service for the members, and it's almost like an insurance policy or a safety net in case you get into trouble. But it's an example of something that, as far as I'm aware, has never existed in the finance industry. So, people have been taking loans for decades, but I don't think any lender has ever been helping anybody to find a job. So it's something that we thought made common sense, and we put it into practice. Sorry, say it again?
Putting loans into forbearance has existed before.
Yeah, people have done that before, but they've tended to kind of go halfway and do that bit, but they haven't then helped you with the more proactive stuff. And it's not easy. It's not easy to get somebody a job who doesn't have a job today, but you can try, and we're doing that.
Is that a revenue center for you as well?
In and of itself, it's not a revenue center. So you could look at it and say, oh, it's a cost center, because we have to pay those people's salaries. On the other side, those 165 people now, who knows? Maybe they probably all would have got jobs because they're great people, but maybe it would have been 3 or 6 months later. But maybe 1 or 2 of them may never have got it. We don't know. So in that sense, we're protecting our bad debt line.
Have you determined the number of basis points added to your interest rate? The interest that you charge?
We don't. No. We don't. I mean, in a way, all of the stuff that I'm talking about today, none of it comes through in terms of the cost for the customer. We get this question a lot. People kind of say, how do you pay for it? We believe that we pay for it, or it gets paid for through a lower acquisition cost. Because, if 5 of you go home today and tell somebody you know about SoFi and about this unemployment protection, this career services thing, and 2 of them end up taking loans, it pays for itself that way. So we have to do it in a way where it's not exorbitantly expensive, but we have a scalable model. And then we also have an entrepreneur program, which may be interesting to everyone here. So Matt is part of the program now. And what do? It's kind of similar to the unemployment protection. We give you some financial benefit. So if you have student loans, you apply to be on the program, you get accepted, you don't have to pay back those loans for a period of time. As everybody here knows, I'm sure that's a welcome relief when maybe you're not earning the kind of salary you could be earning, and money may be a little bit tighter than it otherwise would be. So not having to pay that $1,000 or $2,000 or $3,000 a month, whatever it is, can be welcome relief. And then I think what is more important is the more proactive stuff, where we try and help our entrepreneurs to companies to succeed. And we're growing this program, and it's getting bigger and better, and we're just about to hire someone to take it to the next level. But even now, and Matt, if you're okay if I use you as an example, Wandering Bear Coffee, we partnered with them and sent it to a couple of 1,000, I think, of our customers who signed, 2,500 new customers who signed up in December. We then did shared media and shared social media and featured Matt and Wandering Bear in our Facebook feed. And I think it works well because it's good for us, because there's only so many times a lending company can kind of say, we do loans, they're really good value. Like it gets to be a very boring message after a while. So to be able to bring real people in and real stories gives us a bit more of a human face. And hopefully will agree it was good for those guys because they suddenly got exposed to 50,000 people on Facebook plus because we promoted it, who maybe have never heard of Wandering Bear before, and hopefully that got some more. It's good. You should try it. I got my package arriving just before the holidays. Shared it with the family, so it's great. So things like that. We had a funding kind of event where we had about 20 investors in a room, and we had our entrepreneurs come and present to them. And Jen Bell, Tot Squad, she's been funded by a couple of SoFi connected people, so she found investors through our network. These guys they're putting together a credit kind of new credit card down in California, and we've introduced them to media, and we've given them social kind of social media training and stuff like that. So we're trying to use the expertise that we have and that we've built up to help our entrepreneurs. So if you're interested in this, I think there's a new program coming. The deadline date I think is coming up in June, so I can talk more about that.
So do you have to be a client in order to have access to all this?
You don't have to be a current client. You do have to have, or at least one of the founders has to have student loan debt that they would then refinance with us, and then we would put in deferment. So it's 50% of the entrepreneurs are already clients, 50% become clients through becoming part of the program.
And do you guys give like business loans or something like that to these entrepreneurs?
Not yet. We don't give any business loans yet. It's something that may come in the future. But we're in the process of building a crowdfunding platform. So we may be able to play a bigger part in the funding of your business, in rounding up other people to invest in your business. So that's coming in the next few months. Hi.
Hey, I have a quick question. It's more on the customer service, and
Sure.
I wanted to hear you talk a little bit about sort of training, and you're not clearly going for the lowest cost in sort of everything you just said.
Yeah.
To present, and there's clearly sufficient margin for you to do so. But can you talk a little bit about sort of what differentiates your customer service? You pay them more in terms of training, education, background, all of those types of things.
So I think one of the big differences is that people believe in the product, and when you kind of look at the testimonials and the references and the things that people say about us, they're really happy. And I have the good fortune of going around the country and getting to meet many of our members, and people almost get teary-eyed saying about how much money they've saved. And for many people, it's okay, I've saved $5,000 or $10,000. But for many people, they've saved $20,000, $30,000, or $40,000. And not just the money, but it's meant that they could maybe, like in the case of Victor, feel financially secure enough to propose to his then girlfriend, now wife. Or we heard a story the other day about people who felt financially secure enough to start the adoption process, and now they've just adopted their first kid. So it's changing people's lives in ways just beyond the loans themselves. And I think when the company is doing that and when the employees hear those stories, it then makes it much easier for them to get fired up about their job. So people come into work, just generally happy and wanting to help people. And I think that comes through to the customer experience. We don't get it right 100% of the time because there's a team of now 250 odd people answering the phones. But by and large, I think that broader mission really helps to get the enthusiasm.
Do you think, though, that you, for example, by paying more and having, let's call it this mission focus, do you, for example, attract college graduates, whereas the typical call center might get high school graduates? Do you have any sense?
I don't know the details exactly, but there's certainly a large amount of that. Many of our folks are college educated, and the turnover rate's extremely low. I don't know the exact number, but I know it's really, really low. So in terms of training costs, and most of the costs for a business like that are just training new people, recruiting, training new people, getting them on the job, and then 3 months later they know what they're doing and they leave. So we avoid that. We have extremely low turnover. So I think that's been one of the ways we've been able to do it. It's been a challenge though, because our growth has been very steep, and maybe we had 100 people at this time last year. Now it's kind of 250. So just more than doubling in that short space of time is not easy, but it's something that we've had to go at, and I think we're succeeding. Okay, so the question's been there for a couple of minutes. How many of you, if your bank invited you to a happy hour, would go? Okay, not many hands, not any hands. And I would be the same. I don't think, even if my bank did invite me, I probably wouldn't go. But we started this maybe now 6 months ago, and we've had, these numbers are out of date now, but we've had more than 3,000 people come to our events across 34 cities. And yesterday we did a dinner for single people, like a singles event, and we had 60 people in New York coming to a dinner. It's just a variation of the happy hour general dinner kind of thing. But we're doing career-focused stuff tonight. We have a talk from Joel Peterson, who's the chairperson of JetBlue Airways, and he's talking about his book and maybe similar to this kind of service culture. And it's free for our members to attend. And not everybody does, but many people do. There's more than 80 people signed up tonight. So we're trying to deliver experiences and interactions that go beyond, again, just the loan, and provide you with stuff that can help your career, can help your financial situation, and also help relationships, whether they be working relationships or personal relationships. So we're waiting for the first SoFi wedding to happen from one of these events where 2 people have met, and we'll pay for the wedding. That's our promise. So we're doing these around the country, and I think it's really helping to. Coming back to the question about the cost, some people might say, well, isn't there a cost to here? Could you not reduce pricing? But we've found it a really efficient way to acquire new customers because, I don't know, these 4 ladies were in LA. I think 2 of them were customers and 2 of them weren't. So the other 2 that weren't suddenly get exposed to this new brand, and then a few people at the end of every event end up coming back to us and taking a loan. So is it working? And maybe I've given the game away a little bit, but I believe it is working, and this is when we started out at Stanford, and particularly in the last 12 months, it's really escalated. And I think we've managed to get a lot of press, and I think that's very, very helpful, but a lot of it is word of mouth. So this number is unknown or unheard of in the financial industry. Most people don't tell their friends about who they get a mortgage from or who they get a student loan from, because it's generally not that interesting a topic and generally not the kind of thing you want to talk about. There's more interesting things in life. But half of our customers have heard about us from a friend. So we believe the stuff that we're doing on the customer service side is driving that. The product and the savings is driving that, but also the service. Hi.
So I think you have very creative acquisition strategies. How do you come up with these different marketing strategies for to acquire new customers? And have you tracked where most of these customers are coming from? Is it from the happy hour event, or is it just word of mouth?
So we try our best, but it's very difficult to know exactly where everybody comes from. We have a survey at the end of our application experience once you've been funded a loan. So it only gets the people that go through the process, and we say, where did you hear about SoFi? So in that question, we get a rough idea. But the honest truth is most people don't find out about us in one place. They hear about us in 2 or 3, and sometimes it's the 4th or 5th time they hear about us that makes them act. So maybe that you heard a podcast or you saw an ad on TV, and then a friend told you. So sometimes it's hard for us to know exactly what made the difference. But 50% of people said they heard about us from a friend. So we know that's really big.
Right, and it's just trial and error with in terms of your marketing strategy, like coming up with these happy hour concept.
Yeah, it's trial and error. So I couldn't tell you, like the event that we did last night in New York, I can't tell you today, did it work in a sense. And we're not trying to micromanage every event to make sure that we get 3 loans out of that event and 2 loans out of that. In general, we know that if we keep our customers happy, that referrals will come and they'll bring their friends and good things will come. So it's not like we're all kind of calmer people in California chilling out, but we know that if you treat people well, they'll reciprocate. And if you look at reviews online, a lot of the reviews, the positive reviews are from people who've been to these events. So they get fired up enough about the experience to then take that extra step. And another interesting thing is we're now working with more than 300 companies, big tech companies and banks and consultants and all kinds of companies who are now offering SoFi as an employee benefit, as basically a free employee benefit. So they offer it to their people who come and refinance in student loans with us, and their employees save lots of money. It doesn't cost the company anything, but they look like heroes for telling their employees. So that's another really good acquisition channel for us. Here's some more photos of some happy members and some nice quotes, and we're working to get more and more of those every week. And almost finishing up here, I thought this Yelp review that we got just about a month ago kind of encapsulated what we're doing. So Ben in Oakland, the first paragraph here is about the fact that it's easy and there are great rates, and I think that's important. No one's going to take a loan from us even if we had the best happy hours in the world. Those two things have to go together. But then he bothers to spend an extra couple of minutes to talk about the negotiation seminar that he went to learn how to negotiate a salary better, and he found it useful. So that and this was posted the day after that negotiation seminar. So I think that prompted him to do that, and now suddenly we've got another 5-star review out there. So this is the last slide. In summary, I do believe that startups need better technology than the incumbents, because the incumbents have advantages over startups in terms of scale and brand recognition, so you've got to be better than them. But I would say for many industries, and ours included, don't forget customer service. Don't forget the value of real life customer service, because it really does make a difference. It really does help you to get advocates, and it really can help you to grow your business. Okay, so we've been taking questions throughout, but hi.
Hi, good question. So you started giving student loans, and that was your first, and probably you became an expert, and then you're diversifying into personal loans, and now you said that probably business loans are coming too.
Yeah.
What is your goal for the future? Where is SoFi going?
So the goal is to try to be able to serve you with all your financial needs across everything. So at the moment, student loans was the first one we started with, and then we moved into mortgages and personal loans. We just launched an investment allocation product, so you can now invest a lump sum or monthly amounts, and see, very easy to track, see how it does, and speak to a real advisor on the phone, but with no fees, or $2 a month for a non-member, zero fees for members. And then we have plans for insurance and some kind of transaction account, so you can carry a SoFi card around in your pocket. So fast forward 2 or 3 years, we hope that there'll almost be no need to go anywhere else. But it takes time to get there. But that's the plan. And beyond finance, I should say, we want to be able to make sure we build up the aspects of the company that help you with your career and the relationships, professional and personal. And we can do that we can do all three together, but it's not easy. No one's really done that before. Hi.
Are all of the originations securitized and parceled out to investors, or is this new product that's coming online right now to allow people to invest in assets? Or some of those assets SoFi origination?
No, so our funding for our loans is taken from a wide variety of sources. So we have individuals who are investing their own money, accredited investors investing $50,000 or $100,000. But then institutions provide the bulk of the money, and these are small banks and big banks and international banks and pension funds and hedge funds and not-for-profits investing $50 million or $100 million or more a time. Some of them are investing through securitization, so we've done, I think it's 6 now. Every couple of months we do another one. But many of them are just investing directly in whole loans.
Are those securitizations sliced and diced, or are they?
There's a couple of
tranche retain the same tranche for everything?
There's a couple of tranches. So there are some people that have higher expected return than others, assuming the defaults continue to stay as low as they are.
So what's the spread on a SoFi loan usually between your between your most difficult customer and your most likely customer to? What's that basis point spread right now?
Our fixed rates go from 3.5% up to about 7.5%, 7%. Our variable is like 2.1 up to like 5 point something. So there's a fair, it's a relatively limited range. It's certainly not going into double digits. So the people investing are investing for the quality of the assets. They're investing for the fact that we've had very, very few defaults, and that the people that we are lending to are expected to repay. So it's different to investing in loans that priced at 30%.
So super low default rates.
Super low default rates.
And any prepayment penalties on this?
No prepayment penalties. So in general, we've tried to create a company with no fees. So there's no surprises. So there's no origination fees with any of the products. Because I don't know about you, but when I was, throughout my life, it always annoys me where there's kind of a low rate that it's advertised, and then you apply, and suddenly there's a 2% origination fee or application fee or whatever you want to call it fee. So we get rid of those, and people aren't surprised, and we try and keep it as simple and transparent as we can.
Hi, just wondering about the forbearance. How do you verify that people haven't back lost their job, or is there any technology that you can employ to safeguard yourselves against people look to take advantage of it?
To be honest, I don't know exactly how we do it. I mean, I know the people that do know, so we have a way to check, but my understanding is that we haven't seen any attempts to play the system in that respect. But we need to have that because, we don't want to be just giving deferment to people who feel like going to Hawaii for the next couple of months. So we need to make sure that's there. I don't actually know exactly how we do it.
Are you able to share the average length of time that a loan is deferred?
Yeah, so for the people that are unemployed, they generally, once they start working with us, find employment within 90 days. So it's generally about 3 months. And that number's coming down. I did used to have a slide in here that showed that, and at the beginning it was more like 6 months. And I think as we've got a bit better and a bit more sophisticated and a bit more just good at what we're doing, that's come down to 3 months, and we hope it continues to go down. Hi.
Can you talk about SoFi's own fundraising path?
Yeah, sure. So this will help me to do it. So we graduated in 2011 back here and raised a $4 million seed round, A round. I never really know the difference. And then
no angel money at all.
I mean, it was kind of like a combination of angel, and it wasn't a traditional big VC firms, but it was $4 million, so it's still a weighty amount. And then at the end of 2012, we raised $80 million, which was a big round. And that was on the traction that we'd gained up to that point in launching at Stanford and expanding to a few schools. At that point, we were still restricted to helping MBAs. We were only financing MBAs. And I forget the exact dates, but then we've done a few rounds since then. We did $200 million at the back end of 2014. And then the big one was September 2015, where we actually raised $1 billion, which is a huge amount. And SoftBank was the leading investor in that, and several of the big New York hedge funds. So it raised some eyebrows, like why raise that much money? And we did it because we didn't want to be beholden to the markets, and we wanted to have the flexibility to build new products and to grow those products as and when we wanted to, and to be able to take risks with new stuff and to just not be constrained in our ambition.
Was there pivoting along the way, or was there, as much of a people-centric focus all along the way?
Not much pivoting. Aiko, I don't know if you remember, we bored everyone at business school with presentations about SoFi and how we were going to conquer the world, and maybe you should have invested. I've got the deck in my drawer at work, and it's very similar to what we've done. I think the growth has been bigger than we expected, but the model was never to be a student loan company, and we deliberately didn't call ourselves, greatstudentloans.com or anything, because we always wanted to go beyond that. We had to earn that kind of right, though. We had to deliver a quality product in one area before you can then go into mortgages. Hi.
When you raise a seed round, what kind of traction did you have, or what kind of idea validation did you do? And also, when you talk about having a great technical team, what was sort of your first tech hire, building out that team? Sort of like?
So when we raised the first round, we had executed basically a pilot program where we went to Stanford alumni and raised $2 million from 40 of them, $50,000 apiece, and then lent that money out to 100 students. So that wasn't investment in the company, that was investment in the loans that we were making. But it showed the potential company investors that there was appetite in doing this kind of thing. There was appetite firstly from people to borrow from a better lender, And there was also appetite, perhaps more importantly, for people to invest in this kind of asset, because that was the thing that was totally new. Student loans was like a dirty word. Every front page of the New York Times every other week, there was like student loan crisis, student loan bubble, student loan debt this, student loan debt that. So that was the toughest thing. Based on that traction, we convinced people that we could then grow that to other schools and beyond. And on the tech hire, our first non-founder hire, he was almost like a founder, was our first head of engineering. It was obviously important to be able to build that application system that would work very well from day one. Did I answer your question?
Were there any specific qualifications that you were looking for in the first?
In that individual? He'd actually worked with one of us prior to, so he was a known quantity. So it wasn't just someone off the street who we didn't know.
I wanted to ask you more back to the customer service thing.
Mm-hmm.
So you said that one of the things that you motivate people with is that they feel they're doing something good for the community.
Yeah.
So it's like helping people. But I believe that the more you hear about things like, oh, I have so much trouble because I'm getting married, or oh, I have so much trouble because I just lost my job, it makes the person listening to like get emotionally saturated, or like doesn't really feel any emotions anymore. Thanks that you already have low retention rate, so that means that people who listening to that conversation has been listening to it for a year or two. So how do you deal with that?
So we have high retention. Most of the people when they call us are currently paying on the student loan side, because that's the longest running business. They are currently paying, in many instances, 6, 7, or 8%, and then they find out that we can refinance them at 3 or 4%. So they're happy. About the possibility of saving money. Now, obviously, not everybody gets approved, so we have to. Our guys have to speak to some people that haven't been approved, and that's not an easy conversation. So I'm not saying every conversation they have is with someone who's really, really happy, but there's enough of those every day to get you through the tougher ones. So it's not like you're at a complaint call center where you're just getting people. My cable's not working, my internet's not working, come on. Those guys don't get much love. There's not many people that phone up and say, thanks, it's been working 7 days in a row. I really appreciate your company's hard work. You only call them when there's a problem. Whereas for us, it's different. People call when there's an opportunity. And, we have many mortgage customers who have just gone through the experience really quickly. And I have a SoFi mortgage, but I know I'm biased, but we've heard from many other people that instead of it taking 4 to 6 weeks, it's taken 2 to 3 weeks. Without the fees, and then they're living in their house and thankful, so they call us up and send us stuff, and so not every customer interaction's like that, but there's enough that gets people through. Right.
Can you talk more about how technology played a role in building this company, and at what point did you implement your technology platform? Was it before the pilot program or afterwards? And how did that play a role in being able to scale the company?
So we did everything concurrently, really. So we were marketing the product to potential borrowers before the application system had been built, because we graduated in end of May, and the academic year at that time we were lending to people in school. The new academic year was only 2.5, 3 months away. So really, we had 2.5, 3 months to build this thing. So we didn't have time to build it, test it, check it, and then start, oh, now we've got it, now we can market. So it was a calculated risk in that we were marketing something to say this will be opening up in 6 weeks' time, but put your name on the wait list. So we did that at the same time as building the thing. So we were doing the marketing, assuming that the development would happen. Like, we weren't taking anybody's money or wasting their time, but we were creating this wait list. We couldn't wait until the application had been completely built. Right.
What was your initial marketing budget when you launched, and what were the most effective marketing strategies for you?
I don't know what the budget was. We haven't really had budgets until now. We're getting a bit more professional, and we do have budgets, but it's generally been a case of like, does this make sense? And it sounds overly simplistic, but we never got bogged down in budgets.
So what worked?
What worked? So a lot of word of mouth.
Your initial customers before you get the referral.
A lot of word of mouth again. So we launched back at Stanford, where we just graduated from. So some people were aware of who we were. There was some trust. But I would say that didn't carry us as much as we thought it would do, because we were offering cheaper money than other people. And we thought, why doesn't everyone just rush in? And they said, well, we don't really know who you are as a company. You know, we're giving you our personal information, and like, you seem like good guys, but we don't know if this company is real. So that was a hurdle that we had to get over. We did a bit of Facebook marketing. We had the advantage that at that time we were being very focused on who we wanted to get. So if you went to the Stanford GSB and then later the other big business schools, Columbia included, you know, we could find those people on Facebook relatively easily and relatively cheaply, because it's very honed in. And then getting out to the entrepreneur, you know, the general student clubs and entrepreneur clubs and things like that, just to get the word out in those early days. So now it's much more broad. You know, we had a Super Bowl ad 2 weeks ago, and there's podcast advertising and billboard advertising and stuff. So it's built up, but back in the day, it wasn't particularly sophisticated. Hi.
Can you talk a little bit about the competitive landscape when you're kind of expanding now into other categories where there have been a lot of players, lending club, etc.?
Yeah.
How does your business differ from that, and kind of how do you view this playing out?
So I think it's a good question, because student loan refinancing, we were the very first company to do it. There was no one doing it. So in many respects, we were lucky because there just wasn't any competition. So you could give an average product and you'd probably get people coming in. That's changed. More people have come in. So we've had to keep that edge. But personal loans and mortgages are much more competitive. There are many more existing players. But it comes back to everything I've spoken about here. A lot of this stuff, the product itself has to be good. The rate has to be good. The application experience has to be good. But if you've got people telling your friends, you know, about us, then that just keeps our acquisition costs really, really low. And this is what we're seeing. So this number is relevant for all of our products. So for personal loans, which again is a fairly mundane product, most people are using it to refinance credit card debt at 15 or 20% and coming to 8%. That's not a product that I expect people to go and shout from the rooftops and tell their friends, but they are, because we're looking at where people find that information. So I think that's how we compete with the competition, just having a really good experience, and then it keeps that cost of acquisition down really, really low. I just want to move around a little bit more. Hi.
Just wondering how the increase in rates by the Fed would affect your margins on the origination side and then on the lending side.
Yeah, so the rates went up by 0.25% in the recent months. So our variable rates went up, and our fixed rates actually, the lowest rate stayed the same. But for some people, they were getting a higher rate afterwards, but very marginal. So of course, if interest rates go up really high, you know, by 4% higher than they are today, it will become more difficult for us to refinance student loans, because that student loan for most people is set at a fixed rate. So if you're paying 6% today and you can get a loan from SoFi at 3%, that's worth it. If that 3 suddenly creeps up, then that gap may not be worth it. So the personal loan business and the mortgage business are less prone to that kind of problem, because we're competing with the market and everybody else is in the same situation. That's one of the reasons that we did expand from just one product that did have interest rate risk attached to it.
And just one follow-up, I believe one of the reasons SoFi found this market attractive is because of the regulatory inefficiencies, where, you know, that's why nobody other than the big banks had really approached the business. So after entering in, do you find that advantage has remained, or is the regulatory landscape changing?
Yeah, I think it goes both ways, because at the beginning, many people told us when we were shipping the idea around to people, they were saying, like, you can't do this. There's regulations that prevent you from doing this. Because in finance, it is a very, very regulated industry. So it's very difficult. There's a lot of hurdles put there. And rightly so. You don't want to have anybody just lending money. But once you get through that, and once you work out a way to navigate that and to abide by everything and to set yourself up, it then, in one way, is defensive. It's defensive against other people coming in, because you can't just set up a company with $50,000 just like that. You have to have licensing, you have to have compliance. So it's harder just for, you know, maybe two guys here to set something up that competes with the big banks. I'm not going to say that you need massive scale, but you need some little bit of scale. So I think there's a defensive element there. Can I get to the back?
Thanks. When you, after doing your initial round, 4 years later, when you went to baseline, did you go at lower than 70, or was it more than what you were asking? What sort of metrics did they use to value the company? Because by that time, 5 years into it, you could probably do a DCF or...
For the very first round or the most recent round?
No, for this, your Series B from baseline.
Okay.
At that stage, going 4 years or 5 years after launch, when baseline's looking at you, how do they value it? What sort of metrics do they use? Is it DCF or did they use some other method?
Honestly, I don't really recall. At that stage, we'd proven the concept across more than one school. The first seed round was just one school. So there was always an element of, well, is this just a Stanford thing? Is it just that you can find investors because there's loads of people with loads of money in Silicon Valley? Once we got to the B round, we'd gone much wider than that. We'd gone to other cities and we'd found investors across many different places and we'd lent money across many different places. So we'd proven that concept a bit more. But even then, it was still restricted to business schools, which is not, not everybody. But I think the valuation was based on, well, assuming you can do this at X number of schools around the country, then the business can be worth this. Because the product, it's not like a one-time transaction. If someone takes a loan from you, it's 10 or 15 years, or maybe 5 years or 7 years, but you have an income stream as a company for a number of years. So it's relatively easy to model that out, and that's what they were looking at.
Right, and then the amount that you raised, 70 million, was that
I think we were originally thinking of a lower amount, and it ended up going up, which was a little bit similar to the seed round. And we've always really been of the view that if people are offering the money, as long as it's not too dilutive, then it's better to take more money than less money, just because you never know what's going to happen and the markets change, and it's better to have that flexibility. So obviously you give up some ownership and you see your share of the company dwindle very quickly, but if it means that there's still a company there and you have that flexibility to grow it aggressively, then we took that decision. Hi.
Just wanted to go back to the regulatory challenges. How did you, what were some of the most difficult challenges you faced at the outset? How did you kind of come up with innovative ways to deal with them? And if you can talk a little bit about dealing with regulators and their attitude towards a startup company and a narrative rather than, and then probably your timeline, you couldn't wait for them to come back, over a 12-month period.
So I think the best thing we did was we hired a very senior guy very early. Rob Lavitt is our general counsel, and he had been a partner at a law firm and he'd worked for Sallie Mae as their general counsel, and he knew the student loan industry inside out. And we owe him a lot because he actually, I guess he saw the vision that we had, but he gave up a very, steady, lucrative kind of job to come and join a less than steady, less than lucrative at that stage startup. And I think that was a good decision on our part because it was, expensive in that he cost more money than some 25-year-old who's just graduated from law school. But we believe that it was worth paying that because, and Zenefits have found this recently, compliance is everything in many industries, and you can screw things up very, very easily and very quickly. So I think getting Rob in gave then investors and regulators ourselves the comfort that we knew what we were doing, he knew what he was doing, and that we weren't going to get into trouble on any of that stuff. And then it helped to develop a proactive relationship with the regulators. So the CFPB was very supportive of what we were doing because they were getting thousands of complaints every month about student loans and the very poor level of service in that industry. So they were very keen to see innovation and keen to see fresh thinking. So we've had a very supportive regulatory environment. We have licenses state by state, so we have lots of regulators to keep happy and to be aware of. So it's not easy. It's a big part of the business, but it should be. It's a finance business. You're lending money and you're taking investments.
Just quickly, do you guys also, is part of your customers students that are going to college with no credit, but maybe has, a teacher, and
It's a smaller piece. So the vast 99% of the student loans we make are refinancing loans. 1% are loans to people going to school. And at the moment, it's limited to the top 25, 30 business schools, Columbia included, of course.
Do you think there's a market opportunity there?
I think there is. The reason we've moved more on the refinancing market is it's much easier to find funding for people who've already graduated and they're already working and they're already earning X dollars a year. It doesn't mean that all of our members are rich and earning six figures or anything like that, but having a regular salary and having a path to repayment is a big deal for investors. If you fund somebody while they're in school, you basically have to wait until they graduate. You've got maybe 3 or 4 years until there's any money coming back in. And even then, you don't know if they're going to graduate. You don't know if they're going to get a job. So it's just a much riskier, more difficult thing to judge. So I'm guessing over time we'll go back in there and expand again. But for the time being, mortgages and personal loans and more of our focus. Hi.
You have a slide there that says startups should have better technology than incumbents. Your technology better?
Better. I think it's better in that it's created for what it's supposed to do. I think too many loan applications have been kind of created in paper form when they've been PDF versions and just stuck on the web. And I'm exaggerating a bit, but it needs to be a really clean experience and a really easy experience. And it needs to be mobile friendly as well. And I think most of the big banks still haven't got to that point where it's that clean and that easy. But coming back to what we were speaking about, the customer service as well. If you get stuck, you need to be able to call someone and they need to be able to answer the phone very quickly and they need to be able to answer your question very quickly. And I think we've had that. So that combination of technology and customer service has been good.
I just wanted to ask about the pricing and the underwriting process itself. But how much has changed from traditional banks? Do you use a lot more data when making the decision, or is it about the same?
So it is different. We're looking less at your credit score, and actually we announced recently that we don't look at the score itself. We look at your repayment history. That's an important factor. If you haven't been paying back your credit card debt, you're not likely to get a loan from us. But it isn't the 3-digit score itself that drives our decision. The most important thing is free cash flow. So it's whether you have enough cash at the end of every month to pay us back. And that sounds obvious, but many lending companies don't look at it in that way. So we want to make sure, we want to understand how much you earn and where you earn it from and how stable that is, and then what's your expected outgoings every month. And that will depend on your situation, whether you have a mortgage or how much you pay in rent, whether you have kids and pay for school fees or whatever it is. And then if there's a big enough difference between those two, you earn more than you spend, then we can approve you. But we also look at your years of employment history and the industry that you're in and many other factors that come into it. So it isn't just one or two things.
How did you do that with Victor, the guy who's getting married who didn't have a job?
So for Victor, we gave him a loan before he lost his job. So what happened? He came to us for a loan. He took a loan. Then he felt financially empowered enough and comfortable enough to propose to his girlfriend. That was great. And then they were engaged. And then just as they were about to get married, he lost the job. So that's when we then helped him. And I saw him last week in Chicago. He's just started working for a big company in Chicago. And he's happy because SoFi helped him on that journey. And there's lots of other stories. There's 165 stories like that.
Can you comment on your default rates?
So I'm out of touch. Until very recently, it was like low-digit number of instances, single-digit number of instances. Obviously, as we've expanded, that's gone up slightly, but it's extremely low. It's a fraction of what most banks and most other lenders see. So we don't release the exact number, but it's really, really low. And that allows us then to keep the pricing really low, and it allows us to do everything else we do. Okay. What time are we? I think that's pretty much a full hour. So thank you guys. Appreciate the time and appreciate the time.